Ever since I was a kid, my parents taught me the importance of saving money. My dad invested my savings for me until I graduated from college. Then I started picking my own stocks. Most of the stocks I own are small caps, but I also try to have a few stable blue chip companies in my portfolio. I'm always looking for the best way to increase my returns, but I also don't want to do anything that's too high risk.
Miguel Santos is a 35-year-old civil engineer. After a recent raise, he now earns $72,000 a year. He's a smart investor, but he's looking for innovative investment strategies. Like Miguel, maybe you've also wondered about ways to increase your returns or protect your portfolio from a market downturn. LEAPS may be the right answer. LEAPS, short for long-term equity anticipation securities, are simply long-term options.
I live pretty simply. I enjoy my work as a civil engineer on new construction projects. I enjoy good food and cooking, which means I need to work out to stay fit. Because I don't have many expensive hobbies, I'm able to save a lot of money. It's rewarding to see the money I earn increase even more by smart investing.
Mary Ellen McCarthy is a 45-year-old real estate agent. She earns between $70,000 and $110,000 per year, depending on the real estate market.
I used to think the stock market was very complicated, so it's surprising I'm so into it now. When I first got divorced 10 years ago and started making money from real estate, I knew I should start saving money. So I invested in a few mutual funds and felt pretty comfortable about that. Then after a few years, I got over my intimidation about the stock market, and I found that it's really not that complicated. So now I choose my own stocks with the help of my broker and watch their performance over time. I have 8 stocks in my portfolio. Most of them are large, well-known companies.
Matthew and Ann Johnson have been married for 27 years and have 4 grown children. Matthew is an attorney at a small law firm, and Ann is a hospital administrator. Their combined income is $190,000.
Just 2 more years. We've sacrificed and saved over the years so that we could retire on time and still live comfortably. When we were first married, we started saving money and investing in mutual funds. Of course, we used some of that money to pay for college for our children.
About 15 years ago, we started investing directly in equities. I guess we own about a dozen stocks. Some companies are broker recommended and some we just chose ourselves.
I'm expecting to get a bonus in a few months, but in the meantime, I want to buy a stock now that I think is a good value. Normally, I would call my broker and buy the stock on margin, but I've heard that there may be a better way to do it. I'm eager to find out if LEAPS will work for me.
My stocks have performed well for the last several years, but I think the market will stay somewhat flat for a while. Oh, I want to stay in the market, but I still want to make some money in the meantime. So my broker said LEAPS are a good way to try to do that. I'm really excited to learn more about LEAPS.
When we retire in a couple of years, we'll need to liquidate some of our stocks. Of course, we hope that the market will continue to do well. But we need to protect our portfolio in case the market turns bearish over the next few years. We hope that LEAPS will provide the protection we're looking for.
Well, thank you for joining us at this LEAPS seminar today. Why don't you each quickly tell us why you're here today?
Well, I'd like to be able to buy stock at a lower price.
Same with me. I also would like to sell stocks at a higher price.
Me too.
Yeah.
Well, I want to increase income from stocks I currently hold.
We want to protect our stocks from a decline in the market.
I want to benefit from a stock price's rise without the cost of buying the stock outright.
I want to increase my returns and also reduce my risk in the stock market.
Well, good. So you all did make it to the right place. As you'll learn, LEAPS are very flexible and can be a way to meet all your needs. The objectives you just mentioned can be met through either regular listed options, contracts for 9 months or less, or through LEAPS, contracts for up to 3 years. As you'll learn today, LEAPS have some distinctive advantages over regular options, especially for new option investors. We'll talk about some of them later. In the meantime, let's get a better understanding of options in general. The purchase of an option gives you the right, but not the obligation, to buy or sell a stock for a specified price on or before a specific date. All options, including equity LEAPS, come in two forms: puts and calls. A put is the right to sell the stock at a specified price known as the strike price. A call is the right to buy the stock at the strike price. Don't worry if this isn't all quite clear. It should become more clear in a few minutes. If you purchase a put or a call, you're the option buyer or holder. If you sell the put or call, you're the option writer. Just a few more definitions, and then we'll look at some examples. The price of an option is called the premium. The buyer of an option pays the premium for his option rights, so his loss can never be more than the premium he paid plus his commission. The writer of the option receives the premium because he has the obligation and therefore the risk of buying or selling the stock at the strike price. All options expire on a certain date, and that's called the expiration date. LEAPS are longer-term options. They can have expiration dates up to 3 years from the date of the listing, and that's one of the main benefits of LEAPS. Keep in mind that if you own an equity option, you can exercise your option to buy or sell the underlying stock at any time prior to the expiration date, or you can sell the option itself. Options are traded in units called contracts. Each contract usually represents 100 shares of the underlying stock. LEAPS are listed on more than 400 companies, and that number is continuing to grow. The companies include some of the most highly capitalized and well-known companies in America. The underlying stocks and regular options also tend to be the most actively traded. Well, now that you've got the basics about options, let's look at how they work. There are 4 basic option scenarios. Buying and writing covered calls are strategies 1 and 2. Strategies 3 and 4 involve buying and writing puts. Let's start out with a LEAPS strategy that many people use as a stock substitute, buying a LEAPS call. When you buy a call, you have the option, if you choose to exercise it, to buy a stock at an agreed upon price, the strike price, on or before a certain date, the expiration date. In exchange for this option, you will pay a premium. Why would you want to buy a call? You would typically buy a call for the same reason you would buy the stock itself, when you're bullish on the stock. You will benefit from the rising price of the stock with only a small cash outlay and limited risk, the premium. Of course, unlike stock, LEAPS don't convey voting or dividend rights. Let's go through an example of buying a LEAPS call. Does anyone have a stock they're planning to buy?
I'm thinking of buying shares of General Industries. I think it's at a good price right now and will be a good long-term stock to own.
Okay, that's a good stock to use for an example of buying a LEAPS call. Let's look up General Industries in the newspaper under the section that says listed options. You can also look up LEAPS on the internet. As you can see, there are hundreds of companies listed with several options for each stock. Generally, on the same page as the listing for regular options should be a section for LEAPS. Okay, here it is. First, let's explain what all the numbers mean. $82, yesterday's close of General Industries, is listed below the company name. 110 refers to the exercise or strike price. This means that as a call buyer, you have the option to buy 100 shares of General Industries stock for $110 a share at any time between now and the expiration date, regardless of the current market price of General Industries stock. The expiration date in this case is Jan 01, or January 2001. Since this is January 1999, that would be a 24-month contract. 12 refers to the premium of this option. Since each option contract represents 100 shares of the underlying stock, this means you will need to pay $1,200 to buy one LEAPS call, plus your brokerage fee. The premium depends on 3 main factors: the price of the underlying stock, the volatility of the stock, and the amount of time until the expiration date. The premium for this particular contract will continue to change until the expiration date, depending on these three factors. Now let's take a look at some scenarios just before expiration. Keep in mind that the following examples do not include brokerage fees or commissions. Let's say the stock price increases to $135. You will have the option to purchase a $135 stock for the strike price of $110. Remember, you've paid $12 per share for this option. So if you exercised your call, you'd really be buying the stock for the equivalent of $122. In this example, your potential profit would be $1,300. In this scenario, the call's value would rise to $25. The value just before expiration would be found by subtracting the strike price, 110, from the current stock price of 135. Instead of exercising your option and purchasing the stock, you could just sell the option in the open market. In fact, this is a more common method. On the other hand, if at the expiration date, General Industries stock is worth $105, $5 less than the strike price, the call will be worthless. Since you would not want to exercise your option to purchase a stock for $110 when it's only worth $105, you'll allow the call to expire. Let's discuss your potential profit and loss of buying a call. Your profit potential for buying a call option is unlimited. The higher the stock price rises, the more profit you can make. Keep in mind that LEAPS, like regular options, can lose value if the stock doesn't move favorably and as time passes. Your potential for loss when you buy a call is limited to the amount you paid for the option, $1,200 in this example. This can get somewhat confusing. Before we move on, let's have someone review the reasons to buy a call. Miguel, you said you were interested in this strategy. What do you think?
I think I've got it. I would buy a call if I was bullish on a particular stock. I'll pay a premium in order to have the option to purchase a stock at a predetermined price. I can benefit from rising prices with a small cash outlay, and my downside risk is limited to the premium I pay.
That's right, Miguel. This really isn't as complicated as you might have thought.
I actually own 300 shares of General Industries. I agree with Miguel that it's a good stock to own over the long run, but I think the whole market will stay somewhat flat for a while. Is there an option strategy I can use to make money in the meantime?
That's a good question, Mary Ellen. We just looked at buying a call. Now let's look at the other side of the transaction, writing a call, which is another very popular strategy. If you write a call, it means that you're willing to sell shares of stock at the strike price on or before a certain date if you're called upon to do so. In exchange for agreeing to sell your shares of stock for this predetermined price, you'll receive a premium. A call is covered when you own shares of the underlying stock. For each covered call contract, you will need to own 100 shares of the stock, since, as we said before, one contract represents 100 shares of the underlying stock. So, Mary Ellen, if you were to write 1, 2, or 3 calls, they would be covered since you already own 300 shares of the stock. Why would you write a covered call? There are 2 main reasons. First, you can use a covered call strategy to enhance returns from your investments. Second, you can use covered calls to provide a degree of downside protection. Typically, you'd use a covered call strategy when you're neutral or moderately bullish. You have to be willing to sell your stock since you will be obligated to do so if the call is exercised. When the buyer exercises his right to purchase stock, this means that you, as a writer, are assigned the obligation to deliver the underlying shares. Let's go through an example of a LEAPS call option. Let's pretend, Mary Ellen, that you own only 100 shares of General Industries to simplify things. Looking at General Industries, yesterday's close is $82. 110 still refers to the strike price. This means that as a covered call writer, if you're called upon to do so, you will be obligated to sell your 100 shares of General Industries for $110 a share. This could occur any time between now and the expiration date. The expiration date in this example is still Jan 01. 12 refers to the premium, the price of this option. Since each option contract represents 100 shares of the underlying stock, this means that you'll be paid $1,200 to write one LEAPS call minus your brokerage fee. Remember that this premium can change between now and expiration depending on the price of the underlying stock, the volatility of the stock, and the time remaining until the expiration date.
So let me make sure I understand what I'd be doing if I wrote a LEAPS covered call. I'd be saying that I'm willing to sell 100 shares of general industry stock for $110. To do this, I'll be paid $1,200 minus my brokerage fee.
Right, that's the basic idea. Now let's look at different scenarios of what may happen at the expiration date. Keep in mind that you could be assigned to sell your stock at any time up until the expiration date. If the stock is above $110, the option will be assigned, obligating you to sell 100 shares of general industry stock for $110 a share. You'll still get to keep your $1,200. In fact, if you add your $12 premium to the strike price, you're really selling the stock for the equivalent of $122 a share. If general industry stock is worth less than $110 at the expiration date, the call will expire worthless. You'll keep the stock and also keep your premium. In this scenario, you'll also make $1,200 less your brokerage fee for writing this covered call. This $1,200 provides you with some downside protection if the stock falls. There are a few downsides to this covered call strategy. If the stock price rises above $122 at any time between now and expiration, you could miss out on some appreciation if your stock is called away. So, to review, your profit potential from writing a covered call is limited to the premium plus the appreciation of the stock up to the strike price. So does this make sense? Mary Ellen, since this was your idea, I'm going to pick on you. What are the benefits of writing a covered call?
Let's see. Well, it will allow me to earn money from the premium. And if I'm assigned, I'm able to lock in a price above the current market for the stock. Yeah, I guess those are the two big benefits.
That's right. All right, we've talked about buying and writing a LEAPS call. Now let's switch gears and talk about buying a LEAPS put. Buying a put gives you the option, if you choose to exercise it, to sell a stock at the strike price anytime between now and the expiration date. Some investors buy puts in order to hedge against a downturn in the price of the stock they already own. Buying puts gives some people the confidence to remain in the market. Let's go through an example of buying a LEAPS put. What example should we use?
How about International Computers? We own 200 shares and are afraid that the price will go down before we retire and cash out.
All right, let's look up International Computers. It looks like yesterday's closing price of International Computers was $138. The strike price is $140. As a put buyer, this means that you have the option to sell 100 shares of International Computer stock for $140 a share at any time between now and the expiration date. The expiration date is January 2001. Since this is January 1999, that would be a 24-month contract. The premium is 16. Since each option contract represents 100 shares of the underlying stock, this means you will need to pay $1,600 to buy one LEAPS put, plus your brokerage fee. Now remember, this premium can change between now and expiration, depending on the price of the underlying stock, the volatility of the stock, and the time until the expiration date. Now let's take a look at what may happen just before expiration. Let's say the stock price drops to $110. You'd be selling for the equivalent of $124, a potential gain of $1,400 in option value. Keep in mind, the put premium paid was $16, but as the underlying stock price declined, the value of the LEAPS put rose to $30. You could sell your stock by exercising your put, or you could retain the stock and merely sell the put for its appreciated value to offset your losses in the market value of the stock. Selling the put here gives you back $14 of the $28 per share market loss suffered since the put was purchased. On the other hand, if at the expiration date International Computer stock is worth $160, $20 more than the strike price, the put will be worthless, since you would not want to exercise your option to sell a stock worth $160 for $140. You'll let the put expire. Put losses, of course, will add to the cost basis in the stock you hold. When you buy a put, gains are dependent upon the underlying stock price declining. If you also own the underlying stock, put gains can hedge the loss in your stock's market value. Just like LEAPS calls, the value of LEAPS puts can decline if the stock doesn't move favorably and as time passes. Your potential for losses by buying a put is limited to the amount you paid as a premium, $1,600 in this example. Matthew, you seem interested in this strategy, so I'll pick on you this time. Do you understand why you would want to buy a LEAPS put?
I think so. We own International Computers, but we're worried that the price may decline. Now, let's see, buying a LEAPS put will protect our stock position and provide us with a safeguard if the stock declines. Sounds like the auto and home insurance we have.
Matthew, it's interesting that you say that, because many people believe that options, especially puts, are a form of insurance. Bob, you mentioned earlier that you want to use LEAPS to buy stocks at a lower price. This fourth LEAPS strategy may allow you to do that. Writing a put can obligate you to buy stock if the stock's price falls below the put strike price. For this reason, sophisticated investors often write puts as a way to acquire stock on what they believe to be a temporary price dip. Of course, to write puts like this, you must have the capital available to actually follow through with the purchase of the stock if you're assigned. And just like a stock purchase, your potential risk is the cost basis in the put's underlying stock. You should keep in mind, too, that this strategy must take place in a margin account. Put writing is discussed in great detail in other programs offered by the Options Industry Council. Now that you understand the basic strategies of buying and writing puts and calls, let's spend a minute on the benefits of LEAPS over regular options. The benefits are different depending on which option strategy you employ. For example, if you are buying calls, LEAPS give you more time to exercise the options in a way that allows you to maximize your returns. Because you have a longer time horizon, LEAPS are more forgiving. If you are writing calls, premiums for LEAPS are higher than for short-term options. This allows you to sell your stock at a higher effective price and lowers your break-even point. The same is true for LEAPS puts. You'll receive a higher premium for writing a LEAPS put than if you wrote a shorter-term option. As you've learned, LEAPS have many advantages. The flexibility of LEAPS may help you meet all the investment objectives you mentioned earlier.
I especially like the strategy of buying calls, at least for my situation right now. I'm getting a bonus in a few months, but in the meantime, I want to buy stock in General Industries. I'm going to compare the LEAPS call we looked at today to other LEAPS calls and see if there are any with a slightly lower premium. Then I'll call my broker to place the order.
Since I already own 300 shares of General Industries, I think I'm going to tell my broker I want to write 3 covered calls. I could make some money right now, and if I'm assigned, I could make a pretty good profit from what I originally paid. I'll have to look closely at the premiums and strike prices available. I'd want to make sure I'd be happy selling my shares at those levels if I'm assigned.
This was great. I always thought it would be nice to have insurance on our stock portfolio. You know, buying puts really does act like the other insurance policies we have. We're going to talk about it, but buying LEAPS puts on some of our stocks seems to make sense to help us hedge against a downturn in a market before we retire.
To learn more about LEAPS and other options strategies, call the Options Industry Council to find out when the next seminar in your area will be held. 1-800-444-4360. Or visit the website of the Options Industry Council or the 4 exchanges where options are traded: American Stock Exchange, Chicago Board Options Exchange, Pacific Exchange, and Philadelphia Stock Exchange.